So today's session is actually something that's very relevant for the founders because the definition of a founder is a founder of an idea or an opportunity, and somebody who can convert that opportunity into reality and make enterprise value out of that idea. In order to do that, there are multiple places around the world to do that. Yeah, you can do that in China, you can do that in India, you can do that in Brazil, you can do that in the US. There are multiple places where you can take your idea. Ideas are not specific to one particular nation or a land or a city. It's available everywhere. But what makes Silicon Valley so different is your ability to take that idea and create margin, value, volume, velocity at a phenomenal speed and execution compared to any other place out there. That's the uniqueness of Silicon Valley, right? You're basically adding underlying asset to your idea, because idea is a dime a dozen. No investor will put money into a business unless there is an underlying value to it, correct? Once you're building an organization, when you start building an organization, your primary focus is what? A startup's primary focus is what? To stay alive, correct? To stay alive, that is all it is. Just beg, borrow, or whatever you need to do just to stay alive. In the industry, there are only two types of capital. What are the two types of capital? Customer capital and investor capital. Customer capital, investor capital. Your investor capital, what's the difference between these two capital? One, you got to give it back. One, you don't. Which one you have to give it back? Your investor capital. Your investor capital, you got to give it back with returns. Your customer capital, you don't have to give it back. You just have to give satisfaction. You have to give a product and some satisfaction, acceptable level of satisfaction. Like in an airline, running a business, running a startup is very similar to running an airline. In the sense, like traveling an airline, it's a lot of risk, a lot of turbulence. So when there's a turbulence, first you need to put your mask on, right? So you have to basically survive as a founder or co-founder for you to be able to breathe life into the business and then take it into an upward trajectory of growth. But having said that, you can't just keep hustling and keep doing that. You need to be able to have systems and processes in place and governance and risk management and compliance to be put in place. Okay, so this, the pre-seed is essentially a stage where which you have your idea and you need your idea to be validated, correct? How many of you here have ideas? A lot of ideas? Yeah, all of us have a lot of ideas, right? Write our ideas and back up the envelope sometimes, but ideas are again, like I said, ideas, people don't invest on ideas, they invest into businesses. So you have to basically take the idea, but if you can get somebody to invest into your ideas, you are the best sales guy, the best persuasion specialist, right? So that's the first stage of it. Then of course your seed, which is primarily focused towards your product development effort. You got to get your product out because people are buying your product, not your idea. They might invest into your idea, but ultimately they're buying products. The way in which anyone evaluates an organization's readiness for Series A is your readiness on market expansion. Got it? Are you with us so far? Yeah. Then, because the funding on each one of the stages is different, it has different parameter of success, different parameter of growth. So that's how it's going to be evaluated. And then the growth stage. This is purely how do you take it from one city. Uber was a classic example. Airbnb another classic example. How do you take an idea that works in one city, in Silicon Valley, in San Francisco, and take it across all the cities in the US, coast to coast, and also take it global. And that is an operation on growth stages, B and B, C, and beyond. And finally, IPO. When you really have a great business and you want public money, okay, in large quantity, then you go for IPO. What is the most interesting and most exciting part of that raising capital?
The most exciting was doing a live demo to investors and convincing them all that we had many people that wanted to invest and
got it.
Yeah, creating the FOMO.
Okay, creating the FOMO. The valuation sometimes doesn't have a correlation to the assets or the value or IPs that they currently have. But the beauty of that is if you're able to generate something called traction, you can basically justify that as well. And then the famous method is the DCF, the discounted cash flow model, that gives you the multiplier of every for every equity asset that you're basically pricing. The underlying value of that, the multiple of that, is calculated based on the contribution margin, the internal rate of return, your net present value of that capital that you deploy, and what it could be in time t. So DCF models, and VCs themselves have created new models, which is every organization have their own understanding of what should be the valuation depending upon their capacity to handle risks. You need to have a mathematical model to justify the valuation. Because when your VCs and your investors ask for it, you need to be able to provide a good mathematically defensible valuation, not $20 million, $30 million, $40 million. Now you got to have some rationality behind it. Banks don't take a lot of risk because they need the underlying, their business is based on, can I liquidate that home and recover my money? Can I liquidate, if you're buying a home loan and your loan is, you don't own the property. You might stay in the property, but the bank owns it. Their focus is always in terms of how do I liquidate, and if there is a risky event, how do I liquidate? But unfortunately, you can't afford to do that in a startup. Startup has a lot of risks. It's high risk, high return. So the banks stay away from it. But who operate in this space? The hedge fund managers. Hedge fund guys who are basic, or for to whom the retirement funds basically allocate their investment. They have the capacity to create what's called alpha, which is an higher rate of return. So those guys have a risk portfolio match between the New York and the Silicon Valley. They understand the risk levels because the return on investments on in a Silicon Valley VC fund is in multiples. It's multiples, 24% and beyond, right? Which actually matches the hedge fund guys' requirements, needs. One other area of challenge is the options that you grant as ESOPs can come back and bite you unless otherwise you completely thought that through. Investors also are very, very, first question they ask you is, what's your option pool looks like? Okay. So authorize is what is possible. So when you start off a company, you bootstrap it, you need capital to run your business. So in this case, there are about $250K worth of cash, and if you're spending about $25,000 every month, how much runway time you have?
8 months.
250K, 25K per month, you have a 10-month worth of runway, right? So usually in this period, when you're raising capital, you do not dilute more than 10%. That's the first most important foundational rule. Because every round that you go, whether it's in the series, it's about 15 to 25% of your equity of the founder will get diluted. Without any doubt, because this is basically the industry benchmark. You are going to get diluted throughout the whole process. So that's why the bootstrapping process, you do not go and dilute yourself more than 10%. That's the dilution window. Because if you dilute more, your investors will not find you to be a good negotiator. So this is exactly what we're building in terms of the AI architecture, the market. It's got the foundation models, then later on build the agent framework, then the data, very important to have memory, right? Without memory, your data belongs to the model. So if you want to have sovereignty of data, you need to basically have your own data warehouse, or at least have a data knowledge. And all of them needed to be funded. So this entire stack is getting funded. And right at the bottom is our workflow. And this is actually specifically of the financial institution. But all of them got funded in Silicon Valley. Can you go to the next one?
Yes.
Yeah, thank you. So this is so that's essentially the we're going to not going to spend a lot of time on this one, but just to get an idea. If you can see the right side, start off with Meta, yeah, and then Tesla, XAI, SpaceX. You know, all of them. These are essentially the entire $20 trillion worth of AI valuation, predominantly underlying. There's not just AI. There's a lot of other components to it. But this is what has happened last 5 years. Yeah, last 5 years. And it's going to go only upward. Okay, we can go to the next one. And that's the funding trend line. So $300 billion in global VCs, out of which 83% of that money went to the US headquarters, of which most of them to San Francisco. Okay, 63% of all the startup fund went into California, and of that, 80% of that went into AI companies because of the underlying movement and trajectory, the trend line.